The title of today's webinar is Someone Who is Currently Sitting in the Shade Today Because Someone Else Planted a Tree a Long Time Ago. This is a quote from one of the most well-known investors, Warren Buffett, which carries a profound and also highly multifaceted meaning that is both deep and thought-provoking. Among the different reflections that this quote can lead to, today we wanted to emphasize specifically the significance of the value of time and patience in investments. In fact, planting a tree clearly requires faith first and foremost, patience because you don't see the fruits of your work immediately, but over time and with constant care, they eventually arrive. In the same way, success in investments requires, in addition to the method that must be there, also time and patience. There are no shortcuts in this. And it is not a coincidence that Buffett, in another well-known quote, explicitly states that markets are almost like tools or mechanisms through which wealth is transferred from those who are impatient to those who are patient and have a long-term perspective. So, as we know, the evaluation of stocks, the evaluation of markets, on which we rely so much in our analysis, can remain, let's say, misaligned from the fundamentals for a long time. No one can know for how long, but eventually these excesses that are created tend to subside because they are always driven by fundamentals. Here, in the fast-paced world of today, where instant gratification has become the norm, patience may seem like a somewhat outdated virtue. However, we must always remember that when it comes to investments, patience is essential for achieving long-term success and enduring financial stability. And this is the content that we examine and the message that we aim to communicate in our online seminars. So we are, I must say, approaching the end of a quarter. This often represents a sense of discontinuity, even temporarily, and is frequently the catalyst for changes in terms of rotations and different market dynamics that are established. So in recent weeks, for instance, maybe we will get to this, we have already started to witness some significant changes, at least in terms of leadership, that could potentially shape the markets in the upcoming months and that we anticipate will persist, possibly even with the arrival of the new quarter. However, let's not waste any more time delving into today's title. Let's promptly proceed to our agenda and do so in our customary manner, commencing with the stocks, specifically, as always. When discussing stocks and equities, two factors are important: earnings on one hand and valuations on the other. What do these two worlds tell us? We have already extensively discussed the dynamics we are seeing on earnings. Let's quickly review, starting from the American market. We remind you that we are in the midst of an earnings growth cycle. The new earnings growth cycle has basically just started. And in this graph, we see what the market expectations are, the so-called market consensus for earnings in the American market over the next 12 months. We observe that the market, analysts, and consensus are persistently maintaining earnings at a high level and also gradually increasing them over the course of the past few days or weeks, demonstrating a consistent trend of sustained growth in the financial performance. If we utilize the equal weight index as opposed to the S&P 500, we observe that, figuratively speaking, the tendency of growth and earnings revision is somewhat less prominent in comparison to the S&P 500, where there are evidently the technology companies that propel a significant portion of the growth. But even in this scenario, we still have a configuration that brings to mind a recovery, following a period that still experiences a distinctly sideways profit. The dynamics, on the other hand, are still slightly different in the small cap world, where even earnings dynamics have not yet recovered. So where we see that the market still has many doubts about the recovery, even in terms of earnings, of the small cap world. To provide further detail on the numbers, we recall that the quarter that has recently concluded was a quarter characterized by, and we examine it from the perspective of the left graph, a 4% increase in profits. Instead, for the upcoming quarter, in approximately 15 days, the new earnings season for the first quarter of 2024 will start. Let's see what the market expects in terms of earnings growth for this quarter. We can see it on the right chart for the market that I highlighted. Then we also have the various sectors for those interested in the details. However, for the S&P 500, the market expects a 3.4% growth in earnings compared to the first quarter of the previous year. Therefore, we can clearly see a noticeable growth in profits. It is both curious and interesting to observe how, on December 31st, at the end of the year, these growth expectations for the first quarter were slightly higher compared to previous projections. This is generally a positive thing, the fact that the estimates have experienced a decrease of a small magnitude as we approach the reporting date, indicating a trend of cautious optimism in the market. It is something that occurs frequently. There is this attitude, this behavior of the market that typically tends to decrease expectations. And if we approach a quarter in which expectations have been decreased rather than a quarter where expectations have been increased, obviously it is preferable to find ourselves in a quarter where the reporting season has been preceded by expectations that have fallen, because if these expectations have fallen, it is reasonably easy to think that it is much easier to surpass them. So the fact that they have fallen is still positive news for investors and indicates a potentially favorable market environment. Growth quarter and how growth should characterize the entire year 2024, with expected earnings still growing by 11%, with the market consensus according to some surveys, therefore according to some investigations carried out among institutional investors, seeing an increasing number of investors believing that this year, after practically 2022, but we have already said it, should be the year of earnings recovery. Therefore, a context of earnings that is certainly positive and favorable for the United States, where double-digit growth is still expected, which we consider a bit excessive, but we will see how these dynamics will evolve throughout the year. The anticipated growth in earnings is generating optimism among investors who are hopeful for a strong economic performance. We continue to believe that this P11 is actually a bit exaggerated for the entire 2024 for the American market. Europe appears to be more rational from this perspective. In Europe, the anticipated growth rates for 2024 and the first quarter are not around 11%, but rather around 7 to 8%. We can observe this in the red circle on the right. The first quarter of 2024 is expected to be characterized by a decrease in earnings of approximately 11%. When comparing it to the first quarter of the previous year, we can see that Europe has consistently experienced year-on-year growth. It should thus be a quarter, let's say, without specific enthusiasm in the European market, but instead of consolidation, and we also observe it in this graph. The estimates for the Euro Stoxx 600 essentially undergo a period of sideways movement. However, in a bullish environment, this is significant to evaluate and take into consideration for making informed decisions. If we go and see, therefore, the dynamics of profit, we have observed an overall favorable trend. Surely, important news will emerge from the beginning of the new reporting season, and we will provide comments and closely monitor them together. The other element to consider is valuations. Before delving into the details, let's always remember what we are observing on these charts. The white line represents the price of the reference index, in this particular case, the S&P 500. The gray line and the one we saw before are the profit estimates, and the purple line represents an evaluative multiple. In this case, very simple. We take the subtle price, with those two green horizontal bars representing the standard deviations of the evaluation with respect to its average. So let's see. Taking into account this small premise, the S&P 500 is not a mystery that trades at nearly 21 and a half times earnings on the high end of its valuation range over the past 10 years. This thing is also widely discussed and commented upon by many. Certainly more interesting, as we have been stating for a certain period of time, the equal weight, which we must state is also getting closer. let's say it has exceeded the middle line and is progressing towards the upper portion of its valuation range, there is still space available, but the equal weight is also making its way and advancing steadily.
It is accurate if you can delve into the theme of time in evaluation. That is, we are currently in the year 2022. We have a truly overwhelmed purple line, but it endures for a certain amount of time, and what time has bestowed upon us. Correct, isn't it? If you can delve into this graph a bit, we discuss it frequently, but it is difficult for me to comprehend it from an external perspective, is it not?
If we examine the various excesses, we can also observe the same thing in the year 2020 as well as in 2022. This is applicable to individuals like us and to you as investors who experience these things day after day. Undoubtedly, the temporal aspect is truly something that requires education and understanding for people in our position. She is definitely trained, as in all aspects of our life. In the year 2022, we observed that the evaluations had reached their lowest points, falling below 15 times, but we are already in the second quarter of 2022, and then, prior to the market starting, we reached at least until the month of October. Perhaps it is 6-7 months, and I can assure you that 6-7 months is not a long time frame. There are situations where patience must be greater. In some instances, even 1 to 2 years maybe of patience. If not, even perhaps on certain occasions, even more extended periods of patience are required to achieve the desired outcome. Clearly, market dynamics from this perspective are more favorable because there is many different sectors tend to compensate for the dynamics to some extent. But rightly, Ricardo, thanks for the observation. Obviously, time is crucial. So even now we are at 21 times earnings. We can say that we have been over 20 for several months already, and these several months may seem like an eternity. No one can know the extent to which the market, and consequently the valuation, can remain elevated and for what duration of time. However, the investor who chooses to invest based on what we commonly refer to as the margin of safety principle must clearly consider that this valuation, which is currently so high, will sooner or later tend to return to a more reasonable level, because market dynamics always lead you to that outcome, as history has consistently shown us time and time again. Undoubtedly, time is crucial. I'm unsure if there's anything else you'd like to add to the discussion.
The last thing, and therefore when the multiple, we are talking about 22, it took time and it had reached 14, the price of the SP was 3,500 and there was a lot of negativity. Today we are at 5,200, which means a plus 50% given by a crushed multiple and profits that have not been so negative, but rightly time is needed and expected returns when the multiple is crushed and time is given are higher than expected returns when the multiple is high. However, at the market we will see the fact of facets. So it was just to say that time and safety margin are the two variables that we overlook, because today we are very positive, but we have forgotten where we come from.
Examining the chart on the right, we revisit the topic of small caps. We noted that earnings may have lagged, but they still require upward revision. Valuations also need adjustment. The small cap world theme has resulted in an average valuation. We have moved away from the lows on these worlds, equal weight and small cap. We have brought ourselves back on average. Even Europe, if we look at it from a valuation point of view, has certainly risen from the very depressed level of a few months ago. We have indeed talked about the incredible undervaluation of Europe, and many markets in particular, such as Italy, UK, even Europe is recovering very well. It is outperforming the United States, something that does not happen often in the last period, in the last month and a half at least. So he is catching up a little bit, so he is closing this gap a bit, but we are not actually even in the evaluation average yet. So if the profits of the European market should hold, indeed even grow, European valuations still appear interesting, and they appear especially in some markets that I already mentioned before, so that we already saw in the previous webinars. UK, which still has incredible valuation discounts, Italy, which is recovering a bit, obviously driven by the banking theme, but here too the valuation is slowly rising, indicating a potential for further growth. And then we have the other theme that we also started discussing a bit in our webinars about a month ago, which is the Chinese theme. So here too, we are aware of all the negativity that exists regarding investment in this geographical area. Thus, China has become uninvestable for many simply by looking at the dynamics that characterize the Chinese market. We emphasized how even very significant and profound corrections for this market are somewhat normal. And since we started discussing it, China has also been performing well despite the challenges. Therefore, it is crucial to consider the unique factors at play in the Chinese market when making investment decisions. I need to inform Ricardo that I don't really like this thing very much, because when we talk about something going well immediately, due to the concept of time, it doesn't happen often. For those of us with long time horizons, we tend to organize the portfolio by reducing risk as the price and valuation increase, thus increasing the risk. It's not like winning the lottery where the stock market or sector immediately goes up. On the contrary, once again, we refer to Buffett, right, Ricardo? We have to consider that when we discuss something going well immediately, it's not always the case. Time plays a crucial role in our investment strategies. When Buffett says that when he buys something and it goes up, he is almost sorry because if it doesn't go down, he can't increase it further.
The months in China have been many, but if we also go back to the Nasdaq in 2022, it started to correct in June. It was at its lowest until October, and then it went up more than 100%. The S&P has been at its lowest from June to October, suffering for 4, 5, 6 months, which for the impatient investor feels like an eternity, and then it went up by more than 50%. Suffering and patience are qualities that enable you to perform and achieve success in your endeavors. And China, in our opinion, has suffered a lot, but there is so much negativity that it cannot hurt so much.
In fact, it is in the process of recovering. For technical analysis enthusiasts, which honestly we are not, but we report, the index is also approaching a famous A200 moving average. This moving average is seen and watched with attention by many because it signals a bit the dividing line between the bull market or the bear market. Therefore, even this Chinese market that nobody wants is being closely monitored. With the rally of the last month, it is gradually getting closer and closer to these levels. The market is showing signs of improvement, and this trend is being observed with great interest. At this juncture, taking into account the dynamics of earnings to some extent, having emphasized the importance of valuations, perhaps we can proceed, and I will hand over to you, Ricardo, regarding the dynamics of expectations.
Yes, we've seen price XPCT and SW multiples, WUS at 22, 21, 22x earnings. So GRT positivity and negativity, we had 15x. So XPCTD return of US isn't same as in MA22. In NXT 12 methods we expect. In NXT 12, 24 METs. The problem is that evaluations come next, then the price affects the investor's optimism, which was at its lowest, his bullishness on the market, so his optimism was at its lowest, at the lowest points in the market, and now it is increasing. So the more the investor and the market rise, the more they get caught up in enthusiasm and positivity, which is one of the enemies of optimism when the market rises, which is one of the main enemies of the rational investor. What we see is that we are in a very bullish moment, that investors were certain of the recession. There was certainty of the recession at the end of 2022, the market at its lowest, and now the recession after 12 months of high interest rates above 5%, is no longer a problem. So even the theme of how the narrative adapts, as I justify everything based on price, which goes against the theme of time, the theme of rationality. The other issue is the rate. Before, it was thought that rates would be slightly lower in the next 12 months, so the expectation of low rates had increased. These rates will continue to remain high indefinitely, So this is yet another theme that there is general consensus on. What are the issues investors see on the horizon? Surely commercial real estate, so it's a topic we've been discussing for a while, and we also believe it has some problems. What is the most traded, most followed trade? The Magnificent Seven. Therefore, the Magnificent Seven, those companies that are between 40 and 50 times this year's, for which he has stretched, that the investor says it no longer makes sense to look at the valuations. This is one of the great dangers of the market when one looks at companies and only looks at their quality, which is indisputable, but we are looking for discounted leaders. The technology was on sale until the end of the 22nd. Today, we continue to observe companies that trade at multiples, which have lower expected returns compared to other companies that we will observe that have normal ones. And as we observe the indices, the plus 50 and plus 100% patience and safety margins. The 6 safety margins on these companies have been reduced. So this is a bit the theme of expectations. If we want to say it's AI asking if artificial intelligence is in a bubble or not, the investor says no for 45%. Interesting to see that I saw online that even in electric toothbrushes, they are promoting the impact of artificial intelligence. So it is definitely not what makes the difference, electric toothbrush, but it is a theme. It is the theme that sells. So it is really the theme of the bubble. So the more you say you are inside that thing, the more slowly it swells. What are the most traded trades? We would like to highlight the 2 sectors that we will observe. Utilities and real estate are the 2 least followed sectors. Why? Because they are sectors, according to the market, that do not have this artificial intelligence. They are affected by interest rates, etc. So that's where we go to see, where everyone tries not to look. Last consideration on a sector we were talking about earlier. Tech, the importance of tech. Let's talk about it. We are convinced that tech is fundamental, but I have a small analogy. The red line represents the treasury bond, therefore it represents the bond, not the rate. The purple line is the buttons trend. So in 2022, the narrative that today says that other things, that AI will be the future, that tech companies are not affected by interest rates. The narrative of 2022 was, but everyone knows, that if the rate rises, then the bond falls. Tech companies have to go down because they update cash flows, the usual story. Okay. However, rates continued to decline and tech stocks rose. Why do these things happen? Because first, the narrative justifies a correction also given by evaluations that were too high. The value is touched. What we try to tell you is touched. But it takes time. You see, these months seem easy, but they make you fake against fake, and you are there despairing. Over time, you despair. Today, there are other sectors that lead you to despair. But then you take the recourse to make more than 100% in order to achieve your desired financial goals. Why was it done more than 100%? Why the evaluations were interesting? This is a sector, not a company, that can have specific problems. When we talk to you about the utility sector or other sectors, we are not talking about a company. We are talking about a sector that has narratives that bring it opportunity. Because before it was expensive, it becomes interesting. It takes time that no one can bear these 6 months. It is difficult to endure 6 to 7 months of great suffering, 6 to 7, 8, 9 to 12 months of suffering, because you always wonder. But if it goes down, there is a reason. However, it is a sector. It is not a company that has certain problems. It is a sector. The sector has doubled. So what we want to tell you is that the narrative creates an opportunity given by an excessively high valuation. There comes the time, the effort comes, the suffering comes, and then comes the much higher gain than the average gain that can only come from a path of suffering. Let's go see the current suffering, some of the themes of suffering that are currently present.
And we witnessed it prior to Ricardo. Rightfully, utilities is one of the sectors that the fund management survey among investors indicates we are not taking into consideration, according to the findings. Well, we have discussed utilities, We are aware of the predominant driving theme in this sector, which is the orange line representing interest rates, as we have mentioned earlier. It is important to note that this theme is not being considered. Since the rates essentially, and this is clearly the case, it is a line, it is an inverted graph of the interest rate. So if the rate rises from 2020, since the rate rises, basically the utilities sector is one of the sectors that is suffering a lot. The worst sector in 2022, but be careful, the best sector in 1 month, this must be said. Therefore, as I mentioned earlier, the quarter is often a source of change, which in turn brings new dynamics and influences the markets in various ways. There is no particular reason. This occurs frequently in the quarter, as there are rebalances where the new committees convene to make fresh allocations. They examine the stocks that have performed well and those that have not, and they may opt for new choices that result in rebalancing, thereby uncovering new dynamics in the markets. It appears that something is also changing for these sectors that are sensitive to interest rates. The previous month is demonstrating it to us. And if we take a look at just a few numbers, some simple statistics in this table, we basically see all sectors of the market. We have data from the 12 months prior to the first rate cut to the 12 months following the first rate cut. Therefore, the black line represents the moment when the central bank, in its history starting from 1974, has made the decision to lower interest rates. So the question we need to ask is, what happens to the sectors when the central bank cuts rates? What has historically happened to the various sectors of the market during these periods of rate cuts? This divided into times into temporal horizons. So for example, in the case of utilities, we see that at 12 or 6 months, so before the rate cut, they are the worst sectors of the market, the red ones, practically the reddest ones that are inside the table. Then as the rate cut approaches, so already a few months before the first cut and then the following months, it is a sector that performs very well until it reaches 12 months, where by chance, together with other sectors such as real estate and materials, it is among the best sectors within the market. So even statistics, in short, help us in its analysis and are highlighting the dynamics that we are experiencing these days, which maybe today we struggle to live, to understand, you know? History informs you that you are not witnessing something vastly different from what has already happened. So here, most likely, as previously mentioned, the trigger for the cut is precisely that element that the market is waiting for in order to see a change in narrative. Change of narrative that can potentially occur in the utilities sector, on which I permit myself to make an additional interesting analysis and observation. The utilities sector is always considered as a very boring sector because it is characterized by low profit growth, profits that grow in a stable and repetitive manner, and utilities do not have much room to change their income statement. This sector is perceived as unexciting due to its consistent but limited profit growth and lack of flexibility in altering the income statement. The growth of our utilities is that it is around 5 to 6% per year. So for this reason, it is considered a bit defensive in its predictability of profits. Goldman Sachs, in this report that it published a few weeks ago, attempts to retrace the evolution of artificial intelligence. So even Riccardo Zacconi, the CEO of King, said today that everything related to artificial intelligence is seen in a positive way by investors. And they wonder, okay, but what are the possible phases that artificial intelligence will go through in the future? So today we are in phase one. Phase one is envy. So in reality, phase one of artificial intelligence has been and is monopolized by envy. However, the question is, what could happen next? What are the sectors? Which companies could benefit from this evolution and the potential changes it brings? Already in phase two, they observe the infrastructure sector. The infrastructure is a highly diverse network world. When they discuss infrastructure, they take into account the cloud, they take into account data centers, they take into account towers, they also take into account networks. Networks are, and therefore utilities, paradoxically, utilities risk, because here we are discussing risk, they are transforming into a sector that in some way benefits from these dynamics associated with artificial intelligence in a manner that is somewhat paradoxical. I digress for a moment, but it's a very important topic because we see many companies in this world that are making a lot of investments. Every reporting season of these companies has highlighted increasing capex plans, and maybe the investor struggles to understand why these utilities continue to increase these capex plans, these investments. But as it happens, it's because of the high interest rates. They are borrowing at such high rates. Utility companies are playing a crucial role in paving the way for a de facto new revolution in the field of artificial intelligence. In the same interview a few months ago, Musk highlighted how artificial intelligence, AI, has the problem of being very energy intensive. A lot of electrical energy is required for these systems to function, for data centers to operate, etc. So, if I don't have an infrastructure system that transports a lot of electricity, I cannot develop AI. The development of AI hinges on having an efficient infrastructure system that can handle a large volume of electricity. Without such a system, the realization of AI would be unattainable and progress in this field would be severely hindered. So we comprehend how even this world, which is genuine, exists in its, as I previously mentioned, assurance of expansion, in its almost monotonous growth, really could likewise be traversed by a phase of growth less normal than usual additionally because of these dynamics. But it is pointless to state that by purchasing utilities today, we are not acquiring anything of all this. So these are potential scenarios not even too remote that nonetheless the sector could encounter in the near future. It is important to acknowledge the potential impact of these dynamics on the sector, as they could lead to a deviation from the expected trajectory of growth and introduce new challenges and opportunities. At present, what you are purchasing is a sector such as real estate, which is highly linked to the world of interest rates. This sector is essentially replicating the trend of the rate perceived by investors as a bond. However, due to these interest rate dynamics, it is currently facing challenges and is not being taken seriously as long as interest rates remain low. It is crucial to consider the impact of interest rates on this sector before making any investment decisions, as it continues to suffer from the effects of these dynamics. Clearly, and then I conclude on these sectors, the sectors that are sensitive to interest rates represent a part where we see a lot of margin of safety because the valuations are interesting, the fundamentals are solid. We also need to pay attention to the real estate sector. Because one thing is to talk about commercial real estate with all the problems that we all know and the implications on regional banks, especially, and much more is to talk about the real estate sector in general, which includes many companies that have really nothing to do with commercial real estate. So it is simply a matter of storytelling and time. The weather is evidently, as we have already mentioned before, it causes you to suffer, but it is the secret then of achieving success and overcoming challenges.
Perfect. So we have observed two sectors that have been penalized by interest rates, if we want to express it this way. The narrative surrounding interest rates has created the opportunity, and now it requires time to take advantage of this opportunity. Time and patience are the two crucial factors that ultimately determine people's ability to confront these significant moments of hardship. Let's take a look at two more sectors to better understand the context of this high interest rate and how it directly impacts sectors, while also having indirect effects on economies. So the primary European glass companies, we're talking about an Italian company, a Swiss company, are companies that have experienced no growth for a period of 5 years, starting from 2019. It is not just that only certain other sectors such as utilities are experiencing a lack of growth. Even glass companies, which had experienced a strong recovery until 2022, are currently facing challenges due to a decreasing demand for glass in Europe, as well as globally, primarily because of high interest rates. when experts indicate that interest rates are entering a new phase and are expected to remain elevated for an extended period. It becomes crucial for us to examine the financial statements of these companies and listen to their perspectives. What were the statements of the glass companies? The companies stated that the global demand is decreasing due to high interest rates, which may appear insignificant, but is actually a matter that we believe should be examined closely. Therefore, it is important to consider the views expressed by the companies, as even the glass industry holds significant value. The same reasoning applies to logistics. In this context, we have American and European companies specifically discussing leading companies that demonstrate exceptional returns on investment. However, they too have been affected by high interest rates for the past 2 years, so even in the United States, interest rates are slowing down the logistics sector, which is an industrial sector that is affected by the number of shipments as well as supply and demand, and therefore there is a slowdown in the logistics sector worldwide, which indicates that interest rates are high. So always what we want to convey to you, we prefer to examine companies to inform you about what companies say, rather than creating slogans about high rates or low rates. So the theme of patience has emerged in equity, in stocks, but it is the theme of bonds, perhaps even more so, because in stocks, rightly, the investor begins to see sectors at new highs, equity has returned, problems no longer exist, because then when stocks rise rightly, all geopolitical problems are cancelled out, because the problems are the same as when the SP 500 was at 3,500. They are the same, indeed perhaps even a little worse, but bonds, in our opinion, along with what we have told you, are another one of those sectors of those asset classes where patience can make a difference. Patience here must be maintained and not lost sight of according to our perspective. In this context, we believe that it is the asset class where patience is more challenging to have because the common narrative is different, right? Fiction is interest rates don't harm the economy. Fiction is interest rates were wrong. That is from 2008 to 2020, zero rates, we were wrong. We had 12, 13 years of zero rates, but we did the math wrong. Now rates will stay high forever. What we think is that rates will go down. The first to make them go down was Switzerland, which cut them, surprising the market a little. These are the rates a bit of all, but we think the rates will go down. Our expectations are for higher declines in the next 2 years compared to expectations. So not even in 2024, everyone here, but gradually higher reductions than initially expected will come to fruition. Switzerland has reduced spending because inflation is once again under control. You see it's at 2%. So the big mantra is this inflation that prevents us from making cuts, but Switzerland has achieved its goal. The other countries have achieved their intended goals. Our belief is that Europe is slightly closer. Even the market has begun to estimate that Europe is closer, specifically because if we examine the Purchasing Managers Index, PMIs, Europe is experiencing negativity. It has been in a state of recession for a year and a half, with negative PMIs and industrial production. Consequently, it is challenging to have high inflation. Therefore, the European Central Bank, ECB, is prepared. Industrial production is declining, and inflation is decreasing rapidly. It is challenging to have inflation increase with this data in hand. So it is also beginning to take shape in the United States because Powell has defined the natural rate, which is the sustainable rate. Because when you think about the rate, what is the true rate? The sustainable rate is the rate at which the economy can grow. And Powell has defined it as 2.5. 2.5 today is the 5.5, so you have 3 points of economic restriction. These 3 points create some problems. So American inflation is falling. It's falling. It has become, they call it a bit more sticky. That is a bit more difficult to fall. We will see why it is falling a bit more difficultly. However, during the earnings season, a factor emerged that we want to show you. So the companies that are most exposed to me have gotten closer, while those with the highest exposure to domestic trade, where revenues are higher internally, specifically in the areas indicated by the blue column, have witnessed a growth in terms of sales by about 5%. Consequently, the sales of companies that are more internal have been much stronger compared to those that primarily rely on exports for their revenue generation. However, the profit of that internal company was lower than expected. Can you provide an explanation for this? Why is American inflation higher than foreign inflation? So the American inflation that is struggling to come down, and we will see why, has also affected the most exposed companies. So this is a theme, in my opinion, important for which Powell is taking time, precisely because of inflation. And what is the underlying reason behind the ongoing struggle of inflation to meet expectations? Briefly, there is a strong misalignment between the fiscal policy of the United States and the monetary policy. The red line is the degree of monetary policy restriction. So when it is high, it indicates that we are essentially at the highest levels of the last 10 years of aggressive monetary policy. When it is low, we are at the lowest levels of monetary policy implementation. And the same goes for fiscal policy. So max fiscal policy means being in surplus. On average, the red line, that is, if the gov raises interest rates, it is careful with spending. Raises interest rates, red line, the gov is attentive to spending. Raises interest rates, red line, the gov is careful with spending. Always the same. However, this year, there is a big misalignment. So Powell raises interest rates, but the gov has a deficit of 6 to 7%. Why is there this deficit? There is this deficit for a lot of reasons. Let's not go into the reasons. There are elections this year, but this is stretching things a bit. So Powell is asked to raise rates, but the government is giving money. This creates a problem with inflation. We believe it is solvable, yes, but be careful with high valuations. That's it. So be careful in the market where it is expensive, because it is a situation that has not happened for a while. So you see, there has never been such a drawing between monetary policy and fiscal policy. It is not talked about, but this is it. I mean, it is a state that is giving money and Powell is raising rates. This is also utilized to have a greater number of positive numbers than anticipated in order to avoid keeping everyone under control, considering the fact that there will be elections. But it is a small game that has some side effects. So it is not that it is a pill that has no contraindications. There are contraindications, and one must exercise caution with high evaluations. And it's a bit the theme that the Americans have also said, that is, the main fear is the higher inflation, but the higher inflation is caused by the state giving aid to people. Of other issues in the market, as mentioned, there is a housing problem, which is the difficulty Americans face in changing homes. This lock-in effect occurs when they are unable to refinance their mortgage due to high rates, and it is also impacting commercial real estate credit. Credit card delinquency is at its highest, so we are at the highest levels of delinquency. So be careful, but be careful because evaluations are at 21, 22. If we had been in a period 15 times, similar to the way we were in 2022, the level of attention was lower. Here we are telling you to pay attention between the narrative of great excess and the real problems that exist. Here we have highlighted the economic problems. There are also geopolitical problems. The last thing about bonds that is the same situation of excess. We have spreads at practically the lowest in the last 10 years. So the additional yield to invest in corporate bonds is at its lowest, and the demand for US corporate bonds has increased significantly. So you see, the demand was negative when rates were more interesting. Now it has increased a lot, so people rush to buy corporate bonds. With spreads at their lowest levels, this is indicative of the theme of the challenges in exercising patience. So the challenges in patience prompt you to purchase spreads at their lowest levels because everything will eventually be fine. So you possess a lack of patience, you possess optimism. These are the crucial factors for future challenges and future returns.